In February 2022, the average Toronto condo sold for just under $800,000. Today, it is $620,479. That's nearly $180,000 gone in 4 years. But that decline is not the crisis. That's the setup. The last time Toronto saw conditions this close to today was 1989. What followed was a crash that took 7 years to bottom and 22 years to fully recover. And this time, it is just getting started. To understand 1989, you have to understand what Toronto looked like in the years leading up to it. On the surface, late 1980s, Toronto looked like the strongest real estate market the country had ever seen. The population was growing fast. According to CMHC data, the Toronto region's annual population growth rate hit 3.3% in 1989, a pace the city would not see again until 2023. Immigration was strong, the economy felt solid, and condominiums were the hottest investment in the city. The average home price in Toronto peaked in 1989 at $273,698. Confirmed across multiple sources including TRREB, Better Dwelling, CBC News, and the Globe and Mail. Developers were launching new buildings as fast as they could get approvals. Investors were buying pre-construction units, certain the value would climb by the time the keys were handed over. The same logic repeated in every sales center, at every dinner table, in every financial plan. Prices only move in one direction. Get in now or get priced out forever. Then the Bank of Canada started raising interest rates to fight inflation. At the peak, 5-year fixed mortgages hit 13%. Some investors were carrying loans at rates even higher. A $200,000 condo with a typical down payment meant roughly $27,000 per year in mortgage interest alone, before condo fees, before property tax, before any maintenance. Rents were nowhere near covering those numbers. And then, in the summer of 1989, the buyers stopped coming. A veteran Toronto realtor who began her career at the start of that crash described it in a piece published on Urbanation. She said it was not an instant drop. She compared it to the plug being pulled from a full bathtub. At first, the water level just quietly drops. Then you start to see the spiral forming. Then it gets louder and faster. That is exactly what happened. And here's the part that most people get wrong about 1989. They think the crash was fast. It was not. And that slowness is precisely what makes it relevant right now. The average Toronto home price peaked at $273,698 in 1989. It bottomed in 1996 at $198,150. That is a 27.6% decline, and it took 7 years to get there. When you adjust for inflation, Better Dwelling calculated that it took 22 years, all the way until 2011, for prices to fully recover to their 1989 levels in real terms, not 7 years. 22. Condominiums were hit hardest. Realtors from that era described going back to their clients year after year, delivering the news that units bought in the low to mid $300,000 range were now worth somewhere in the low to mid $200,000 range. Price declines of 25 to 35% on condos specifically, according to first-hand accounts documented by Urbanation. Some buildings had dozens of never-occupied units sitting on the market under power of sale. Others had unsold inventory in receivership because the developer had gone bankrupt. Investors holding multiple units were the most exposed. When rents cannot cover the mortgage, and they could not in 1989 either, every month that passes is another month of losses. And if prices keep falling, there is no clean exit. You cannot sell without locking in a loss. You cannot hold without bleeding cash. You wait, hoping the bottom is close. It was not close. It kept not being close for years. That is the part that made 1989 so damaging. Not the initial drop, the length of it. the slow, grinding decline that kept going long after most people had convinced themselves it was nearly over. Now let us bring this to 2026, because the parallels are close enough to be uncomfortable and the differences are important enough that you need to understand both. Start with the similarities, because they are striking. In 1989, investors flooded pre-construction expecting appreciation. The same thing happened between 2018 and 2022 in Toronto, at a scale that dwarfed the 1980s boom. CIBC and Urban Nation research found that by 2023, 77% of Toronto investors with new condo mortgages were already losing money every month. The average negative cash flow was $597 per unit. That number has almost certainly grown since. In 1989, when buyers stopped showing up, the entire development chain froze. That is happening again. New condo sales across the Greater Toronto and Hamilton area in 2025 dropped 60% from the year before to just 1,599 units, the lowest annual result since 1991. In the first quarter of 2026, just 246 new condos sold across the entire region. That is 94% below the 10-year average. And for the first time in approximately 30 years, not a single new condo project launched. Zero. In 1989, demand collapsed partly because the pool of renters and buyers was shrinking. The same dynamic is playing out now through a different mechanism. The Bank of Canada reported that net newcomers to Canada dropped from 1.4 million in 2023 to under 300,000 between the fourth quarter of 2024 and the third quarter of 2025. The renters that investors were counting on to cover their mortgages are not arriving in the numbers the market was built around. And in 1989, the market did not collapse dramatically in one quarter. It quietly declined for years while people told themselves the bottom was in. According to CMT News in March 2026, citing TRREB data, the current correction, at 24.4% for all Greater Toronto Area homes, is already deeper in 4 years than the first 4 years of the 1989 crash, which registered 21.3% over the same window. Read that again. We are already deeper into this correction than 1989 was at the same point in time, and the 1989 correction had barely started when it was 4 years old. But here is where the comparison gets complicated, because 2026 is not 1989. And understanding the differences is just as important as recognizing the similarities. In 1989, the crash was fueled primarily by speculation, high leverage, and loose credit. When the Bank of Canada raised rates, over-leveraged investors could not refinance and could not hold. The crisis spread quickly and brutally because the lending standards that should have prevented it did not exist. Those guardrails exist now. Mortgage lending rules are significantly stricter today. The stress test requires buyers to qualify at rates well above what they are actually paying. Developers need approximately 70% of units pre-sold before lenders will finance construction, which means projects that do get built have a base of committed buyers before they break ground. Mortgage arrears across Ontario sat at 0.22% in the first quarter of 2025, according to Equifax data cited by CMHC, well below the peak of 0.68% reached in 1992 at the depths of the last crash. And CMHC, in a detailed comparison report published in September 2025, said the current downturn has parallels to the early 1990s, but that the structural differences, including stricter lending, a housing shortage beneath the oversupply of small units, and a more stable economy, should limit the depth of the damage. So the base case is likely less severe than 1989 in absolute terms. CMHC expects prices to recover faster this cycle than last time. But here is what CMHC did not promise. They did not promise it would be short. A legal and market commentary from 2026 makes an argument worth sitting with, that in some specific ways, this crisis could actually be harder to resolve than 1989. Not because the numbers are worse, because the solution is less obvious. In 1989, when rates eventually came down, carrying costs dropped, cash flow improved, and the market gradually found its footing. The mechanism for recovery was clear. In 2026, the problem is different in nature. Construction costs are significantly higher than they were at the pandemic lows when these projects were priced and sold. Developers cannot simply cut prices to match what the resale market is offering, $859 per square foot on resale against $1,189 per square foot on new, without selling units at a loss on every single one. The math of new construction does not work at resale prices, and buyers will not pay the new construction premium when an essentially identical unit is available cheaper in the resale market today. That is not a rate problem. Cutting rates does not fix it. It is a structural pricing problem with no clean solution. Before we get into what this means for the 28,000 completions hitting the market right now and what owners should actually do, if this kind of data-backed breakdown is useful to you, hit subscribe. We track the Toronto market with verified numbers every week. Now back to it. The real tension. In 2026, the reason some analysts are saying the crisis has just started, even though prices have already been falling for 4 years, is sitting in those 28,000 completions. These are buyers who signed contracts in 2020, 2021, and 2022. They signed at peak prices. They waited. They planned their lives around these units. Now the buildings are finished and the closing dates are arriving, and when their bank sends an appraiser to confirm the value before releasing the mortgage, the appraisal is coming back at 2026 market prices, not 2021 contract prices. This appraisal gap is the real decision point. The gap between those two numbers can be enormous. A buyer who agreed to pay $675,000 for a unit that now appraises at $590,000 has an $85,000 shortfall that the lender will not cover. That $85,000 has to come from somewhere: cash, a personal loan, family, or the closing falls apart entirely. The Globe and Mail reported that power of sale listings across the GTA have been skyrocketing, and in Toronto specifically, half of all power of sale listings are for condo apartments. A law clerk at a firm handling these proceedings told the Globe and Mail she has been consistently overwhelmed for almost 3 years. She noted something else that maps directly to the 1989 parallel. It used to be rare for a lender to record a loss on a power of sale in the condo market. In 2026, she said, it is becoming increasingly normal. Lenders taking losses on condo power of sales. That is not a blip. That is a structural signal. Royal LePage is forecasting condo prices will drop another 6.5% in 2026, bringing the average GTA condo to roughly $615,000 by the fourth quarter. The March 2026 TRREB Market Watch confirmed prices are still down 9% year over year. And while March 2026 showed the first back-to-back month of tentative stabilization, benchmark prices edging up 0.3% month over month, that is one data point, not a recovery. In 1989, there were multiple false bottoms before the real one arrived. People called the bottom in 1990, in 1991, in 1992. They were wrong each time. So what does the 1989 map actually tell you to do right now? The most important lesson from 1989 is not the percentage decline. It is the timeline. The people who made the worst decisions in the 1990s were the ones who did not understand what phase they were in. They thought they were near the end of a correction when they were at the beginning of a multi-year grind. They stretched their finances to hold on, burned through their reserves, and eventually ran out of runway before the recovery arrived. If you are an existing investor holding a condo that is bleeding cash every month, The question the 1989 map forces you to answer honestly is this: can you sustain these monthly losses for another 2 to 3 years? Not optimistically, not in the best case. In the realistic case, where prices continue to drift lower through 2026 and into 2027 before stabilizing, if the answer is yes, the long-term fundamentals of a city that keeps growing and is building almost nothing by 2029 are eventually on your side. If the answer is no, the 1989 map suggests that waiting and hoping is how people ended up in the worst positions of all. If you are a pre-construction buyer with a closing date arriving in 2026, get independent legal advice immediately, not from the developer's recommended lawyer, not from the agent who sold you the unit. Understand exactly what your contract says about closing obligations and developer recourse before you make any decision. The difference between a managed situation and a financial disaster often comes down to what your specific contract says and whether you understood it before you acted. If you are watching this as a prospective buyer trying to time the market, the 1989 comparison offers a genuinely uncomfortable answer. Nobody timed the 1989 bottom correctly in real time. The buyers who did well in the cycle that followed were not the ones who caught the exact bottom. They were the ones who bought when the numbers worked for their situation and held long enough for the city's growth to do what Toronto's growth always eventually does. CMHC's September 2025 report said something worth ending on. They acknowledged the parallels to the 1990s, but noted that history does not always repeat. The differences in structural factors, stricter lending, the housing shortage that lives underneath the current oversupply of small units, and a more stable, broader economy should limit how deep this goes. But they did not promise the length of the cycle would be short. That is the honest answer, not panic, not denial. A clear-eyed look at what phase this actually is, and the 1989 map says this phase has more to run. Everyone is watching what happens next. If you found this interesting, check out this video here.